much of this stimulus has already been priced in by the markets?
Yeah, we've seen a little bit of a relief overnight as these talks progress, and we finally have a number of the participants serious about getting a deal done, obviously with the coronavirus resurgence. So we think it's likely, and we think perhaps some of it's priced in, but this is a bridge. This is an important bridge given the resurgence in coronavirus to next year. This plus the Fed and easier monetary policy, but the most effective fiscal policy, as we know, is the vaccine in the medium term.
And that's enough to push equity markets higher. I mean, if you take a look at global stocks, they're up 13% in November alone. How much more upside from here?
Yes, short term, we've of course had a strong rally and priced in some of the positives of the vaccine, clearly. We need to consolidate perhaps some of these gains. We've seen powerful rotation from growth into value, which we kind of had advised back in September on the vaccine as a catalyst. What we've seen historically, though, after this kind of rise in November, a 12% rise, global stocks, on average, stocks are still up 3 months, but as well as 6 months following these kind of powerful double-digit rises. So this will create buying opportunities in the coming months.
What will happen to tech stocks going forward? They've been pretty rock stars. I mean, the Nasdaq up 40% year to date. Can they continue to be attractive given that, you can find better valuations elsewhere?
Correct, Linda. We think it's about barbell approach. You need to have some cyclical exposure in the portfolio separate from technology and even outside the FANGs or BATs. So it's about stock selection technology. We still like longer term trends in 5G, AI, e-commerce, etc. But you need to look at semis, you need to look at sub-suppliers, you look at other players in that space where you still see incremental value. But if there's a significant tech correction, we would buy the winners again.
Prashant, tell me, many people say that we are at the moment in a bubble, but the thing is, unlike other bubbles that we've seen in the last few years, we've never had the cost of borrowing as low as it is, with nominal interest rates at negative or virtually zero. And that makes a huge difference, doesn't it?
Yes, I mean, we've seen this story since 2009 in various phases. Low nominal rates, negative real yields lead to appreciation of financial assets. That's where it pushes the marginal investor, and that's what we've seen in equities. In addition, equities are a discounting mechanism. They're looking 6 months forward. So they're looking at some level of recovery in the economy next year, and with some vaccine rollout as well, boosting growth next year. But yes, you have elevated PEs with low nominal yields.
Well, indeed you do, and you've also got a bond market which is telling a slightly different story. One where we're seeing a steepening of the yield curve of late in the U.S., and there's more and more whispers about inflation out there, but many people discount that. What's your take?
Yeah, currently on a 12-month basis, given the excess capacity in industry as well as unemployment, we think there's a low likelihood of a massive increase in inflation. Clearly, it will increase. We do predict inflation to pick up year on year globally. But given that if you think about pre-pandemic, we had a U.S. unemployment rate sub 4%, and the Fed still did not hit its inflation target. So we're still far away, we think, from a noticeable increase in inflation, though, of course, yields already reflect that, and we expect 10-year yields to rise into, say, a 12-month view up to 1.25 to 1.4%.
Prashant, I was just looking at your research, and you're looking at the moment some of these selected fallen angels in credit as a way to go. Can you give us a few examples of them and what they really are ultimately?
Sure, we have this insatiable search for yield clearly from investors, and there's no silver bullet to solve the issue, given we have 18 trillion of negative yielding bonds globally. But one area of a subsegment, we liked investment grade historically. We still like it, but clearly those yields are lower. But there's a number of credits which are at the lower end of investment grade that have come out and that could come out due to credit downgrades because of the recession. Within that, its key is bond selection, finding bottoms-up credits we like that can repay you and obviously have healthier balance sheets. And within that space, the baby sometimes is thrown out with the bathwater. If we see some volatility in credit, we're going to focus on buying some of these credits where you get incremental yield pickup relative to investment grade, but safer credits than high yield.
In terms of best carry trade for 2021, are we looking at the likes of the rupee, the rupiah, perhaps?
Yeah, we like EM currencies. We have a weaker dollar view. We've had that view for some time, so we could see some appreciation there. But also on the fixed income side, EM local currency bonds for incremental yield pickup as well.